Okay, so it is a great pleasure and privilege. We're going to have a mini session now on finding values in the traditional equity markets. And for that conversation, it will be a mini conversation, I'd like to welcome Mr. Andrew Brenton to the stage, and to give you a little bit of background on him. Andrew Brenton is the CEO and co-founder of Turtle Creek. Previously, Andrew founded and was the CEO of the private equity subsidiary of the Bank of Nova Scotia, where he invested $300 million in control positions of a dozen Canadian private companies. Andrew was the head of a high technology investment banking practice of Scotia Capital in the early 90s, and prior to that he was a founding member and managing director of the firm's mergers and acquisition practice. Andrew joined McLeod, Young & Weir, which was the predecessor of Scotia McLeod, in 1984. He received his MBA from the Richard Ivey School of Business and in 1984, I'm sorry to age you here, and from Mount Allison University in 1980. Ladies and gentlemen, welcome Andrew Brenton to the stage. So, Andrew, I mean, you know, we had our next conversation with Leon Black. Hopefully, he'll get here on time. But our next conversation with Leon Black is on finding value in today's market. Leon will probably cover the gamut of credit, real estate, private equity, everything other than traditional public markets. Could you tell us where today in the public markets you're finding value?
Sure. So, as you mentioned in my bio, I, back in the 1990s, did do private equity investing with my two partners, and we, in fact, shifted from private to public investing. We developed a view, and I think someone who was on the stage a few minutes ago or in the last session, one of the sessions, referred to the fact that he was taught the efficient market theory when he was at school, and then he went to Wall Street and quickly realized that none of it was true. So I have the same story, only I came to Bay Street and realized that none of that was true. So in essence, we're finding value, but what I would describe, you first need to understand our approach. So our approach is to take a very long time to get to know our companies. We have over 17 years, and I always preface it with only, but I think it's correct, only owned 80 companies. And at any time, we own 25. So if you do the math, that means we've been changing 3 a year. And so I can't speak to the broad market. I can only speak to the companies that we own today. And some of them are quite cheap. Our experience through 17 years, which has us meant that we've seen many different market environments, from the tail end of the dot-com to the credit crisis and financial panic, is that in every instance we've been able to be fully invested and find value, with the one exception of the spring of 2000, where we had over a third of the fund in cash. So going into the credit crisis, we were fully invested. Today, we're roughly fully invested. Now, I would stress that we're not saying the market isn't overvalued, fully valued. We don't take a view on the public market. We simply look at the companies that we own. And even within the 25 that we own, and I looked at this the other day, 4 of those companies are trading above our estimate of intrinsic value. But the key for us is we don't own very much of those. We own, in one instance, if it goes up a few percent higher from here, we won't own any of that company. So we find value, but it's not as though we're finding value in hundreds of companies.
Well, so you'll excuse me for being a little bit of a cynic. You know, I mean, come on, we've had a 7-year run-up in the equity markets. It's hard to believe that there's still, you know, that the equity markets, which many of the speakers up here have said are frothy, that there's still value to be found. So could you just elaborate a little bit on how you actually unlock that value? Because for many of us, it's hard to see where it comes from.
And I'm surprised too. I mean, so it's easy to make the statement that at the end of 2008, our portfolio was cheap. I mean, and so if we frame it in terms of the long-term expected return, so we simply think about our companies and how much cash they're going to generate and pay out to us as longtime owners of that company. And if you think of that as the bottom in terms of valuations since we've been operating, the long-term expected return over a 10-year period was over 20%. So that was a terrific time to invest in our fund. The long-term expected return in the spring of 2000 was only 6 or 7%. And that's why we weren't fully invested at that time. The surprising statement that I make, and I am surprised, is the portfolio that we own today, the long term, doesn't mean that we won't have a decline in our share prices in the short term, but the 10-year long-term expected return for our portfolio is around 16% net to our investors. And that is surprising to me. And I think it's partly because we try to identify companies that are most likely going to be misunderstood at a point in time by the public market. If you believe the markets are not efficient, we try to find our, if you will, circle of competence. In the last panel, it sounded as though one of their key areas of expertise is biotech. We know that our key area of expertise is not biotech. So we try to identify companies that are somewhat hard for the market to understand, but we're actually capable of understanding it. And so I describe it as we have a bit of an intuitive pull toward companies that may be mispriced at times. And so we own some companies today that we think are quite mispriced by the market. And I would emphasize it's not 25. As I said, 4 of our companies are, in fact, fully, if not frothily valued. But we're happy to be quite concentrated. If you think of the fact that we own 25 companies, 10 of our companies represent 65 to 70% of the fund. So it's that willingness to have, in the case today, 12% of the fund in one company. The next largest holding is 11%, and then it drops down to a couple at 9%. Those companies are underpriced by the market today. And in each one of those cases, though, if I go back a few years, they were fully priced by the market. So our experience has been that in pretty much any market, there's always something that is mispriced. As an example, we own a couple of companies that are in the oil and gas. Well, I should say one company in particular that the market perceives is in the oil and gas industry. And in fact, that's its legacy. And some of its business still comes out of the oil sands. But it's been so bad in the oil sands for them that it's virtually down to zero. And in the meantime, their U.S. operations, which are not involved in oil and gas at all, are growing quite strongly. The market hasn't picked up on that yet because you've got one part of the business declining, the other part growing, and the top line's been relatively flat. At some point, the market will figure that out. I don't know when, and in the meantime, we'll just simply own it.
Great. So, Andrew, you've been running Turtle Creek with your partners for quite a number of years. You've had very impressive returns. To date, since inception, they would be roughly
25%.
25% per annum over a 17, 18-year period. So, I mean, clearly you're capturing tremendous, what in financial parlance, alpha. How does that jive with your risk management system? I mean, we heard from Sam Zell a little earlier that he's really not concerned about capturing, the last dollar. He's not as concerned about the upside. Really, all he focuses on the downside. So, could you talk a little bit about risk management in your business and how that jives with the fact that you've had these astounding returns over an 18-year period?
Well, so I thought Sam's comments were right on the mark, and when I heard him say that, and I thought that's often what we describe to our investors, that our approach, we are in one asset class. We're happy to be in one asset class. Our approach is really, we force our portfolio to be 25 holdings, and that's a critical point. We force it to be a fixed number of holdings. But once we get past that one constraint, we then have no constraints in terms of weightings. And then in essence, what we're doing is we're trying to construct the least risky portfolio that we can. So to take the example today, if we owned a lot of these 4 companies that I mentioned that are trading above our view of intrinsic value, which really means that if you buy and hold it, we think you'll earn 7 or 8 or 9% long-term returns. That's risky. It's not that I think the companies are risky, but the valuation is risky. You could look at your portfolio in 10 years and say, well, the company's done well, but the share price is the same. So in effect, we're every day trying to drive our incremental dollar to the lowest risk position. So when I say something, our biggest holding is 12% of the fund, it became 12% of the fund because the share price has gone down. And so in essence, I agree completely with Mr. Zell that we are focused on making positions large when they're low risk, because typically buying something at a low price, as long as nothing really bad has happened to the company, if it's simply market noise, a couple of bad quarters, that's a way to minimize risk. But equally important, and I think this is something that we do again on a daily basis, it's equally important to be disciplined in the reverse. So any one of our companies, if the share price is rising today, we are selling stock. And it's simply because we believe we own the right amount yesterday. And so in fact, in one instance, one of our company's share price was up sharply today. And we were offering up little bits of stock as the price rose. So our approach is essentially risk minimizing within the context of wanting to be long public stocks.
Fantastic. And so you're predominantly a Canadian company, Canadian equities.
Right.
So we're in Canada, but and we appreciate that. And there's also tax considerations. But we're only 3% of GDP. So why would you constrain yourself to being predominantly Canadian?
So we don't constrain ourselves in the sense of we would own a company based in Europe. We just never have. In the life of the fund, as I mentioned, we've owned 80 companies. 70 of them are head officed in Canada and 10 head officed in the US. Today, of the 25 holdings, 4 are head officed in the US and 21 are head officed in Canada. We believe that it takes a long time to get to know a company. And we believe it's not so easy to sort through the public market to identify those uniquely well-run, honestly run companies. And so, and that is our background from private equity, having sat on boards and had control positions. We've seen the good and the bad. So effectively, our approach has been job one was to work our way through Canada, all of the companies listed on the Toronto Stock Exchange. Our job today is doing the same thing in the US. I don't know if that job will ever get done given the size of the US market. I should mention that the average market cap of our companies today is about $7 billion. So we're not a small cap fund. Maybe in the US they think of those as small caps, but think of it as a $1 to $15 or $20 billion market cap target. And in North America, there are close to 2,000 companies that are public and they're in that market cap space. So this week, in fact, you mentioned my 2 partners. We now have 8 people in total on the investment team. One of my partners and a non-partner was at a conference in Vegas looking at a bunch of US companies. And my other partner was in Chicago and then routed back through New York to meet with one of our companies. So, and to go to another conference. So if you think of our approach as, I think it's completely logical that initially we would have owned Canadian companies. And I think over time it'll be quite logical if that 4 US grows from 4 to some larger number. And potentially, probably someday, if we have the team and the resources, we may own companies head officed elsewhere.
Okay.
Having said the heavy bias to Canada, those are the head offices. So if you think of our portfolio today, and it's been this number for quite some time, over 2/3 of the cash flows and the revenues of our companies are generated outside of Canada, and over 1/3, in fact, outside of North America. So it's often a bit of a artificiality, a fiction as to what people think it's a Canadian company, therefore the revenue and cash flow are in Canada, and it's not the case. So again, it was another comment from Sam Zell saying, if I go to emerging markets, I want a partner. We've taken a bit of a different approach. We say, if we're going to go to emerging markets, we want to do it with a Canadian or a North American head office and governed public company that then knows how to deal in those emerging markets.
Great. And Jack Bogle made the comment earlier that the prospects over the next, I believe he said 10 years, for equities were quite dismal. And he also wasn't terribly excited about active management in general. So what's your perspective on some of his remarks? And the indexing in general, how do you view the role of indexing vis-a-vis the strategies that you're employing on a go-forward basis?
I have to say that I read one of Mr. Bogle's books in the last year, and not the one I think that might be here called Enough, but another one, maybe the most recent book, and it's there's one really important idea in that book. There are a lot of good ideas, and I actually, we write little articles for our investors, and I picked up on that theme, in essence talking about the double agency problem in the public markets. That for 100 years we've had the issue of the separation of owners and managers, and now with the professionalization of the investing side, you've got a separation, or money managers often focused on the business of money management and their firm rather than trying to maximize returns for investors. So I thought that was a terrific thought in terms of the double agency problem. I actually agree with the thought that for most people, for many people, and we've written about this, that passive approach to public investing is a terrific starting point, almost as a baseline. And then if you can find skill, it exists. There's skill among the people who've spoken today at this conference. If you can find skill, then great, access that. But start with the idea that not everyone generates alpha. And to a large degree, I think these studies, they're measuring the wrong people. They're measuring large public fund management companies that arguably have become too big. The reversion to the mean, of course, is a factor because the actual investment managers in those firms are changing often. And so I think partly it's an issue of not measuring the right people when they do those studies. And then in terms of the impact on indexing, as a larger percentage of the market, we've seen this over our 17 years, the flows of funds as a result of changing weightings into the companies that we own and follow has created bigger price swings at times. And of course, because most of the indices are cap weighted, they perpetuate themselves in both directions. We don't try to predict that. We are a price taker. And so, but I can tell you there are a number of cases in the last few years that we've been able to own more of a company, or frankly in the reverse, sell more of a company than we otherwise would have because of the accentuated price movements that have come from companies being added or taken out of various indices.
Great. I'm going to ask you a personal question. I know you're a serious golfer, and you take your golf very seriously. And the reason I know that is because I've been invested with you for quite a while. I've never gotten an invitation to your golf tournament. Partly that's a testament to my golf game, but just out of curiosity, you know, is there any lessons that you have taken from some of your golf successes, victories, and achievements, and that you've applied to your investing?
No. No. So, in fact, many years ago, as a bit of a team building, if you will, when I was involved in private equity, we had a monthly golf outing. And what I discovered is that my two partners, my current partners, who were my partners at the time, are probably the two worst golfers that you will ever see. And so they haven't played in years. They do not play in the Turtle Creek Cup. And So I don't think I've ever been able to use sports analogies to anything that we do. It's really the old-fashioned getting to know companies from the bottom up.
So what is an optimal training for an investor?
In what sense?
In the sense, well, I'm looking from a passive selecting managers, but if you were to identify a training program for an investor, what would that be?
Yeah, that's a great question. I often, I know what we do. We're looking for companies that are terrifically managed. We then do our own work and we decide how much we own. And I've said this to Ian, I'm not sure how I would come at, as an investor, allocating among a variety of asset classes. We've kept our life personally really simple because we're in one asset class and it's 100% of our own personal family assets. So I don't know how to wouldn't know how to allocate between the variety of asset classes. It's not something we've ever thought about.
Right. And can we come back to, because the conversation with William Thorndike this morning still resonates. Some of the lessons and takeaways from his books and The Outsiders about these outsider CEOs. What role does some of the interpersonal and quantitative aspects of the management teams, what role does that play in your investment decisions?
So I can't make a list of the factors when I look at our companies. Well, there are some commonalities, perhaps, but it's a little bit of the thought that I can't describe what we're looking for, but I know it when we see it. And once you get past the honesty and the integrity issue, there are lots of public companies that pass that test. I think it's just more speaking and listening to management teams enough. And if you add up all of the time and where they don't say stupid things, again, I'll come back to Mr. Zell's comment about, I'd actually preface it by saying we think the world is an extraordinarily complicated place, and it's becoming more complicated all of the time. But at the end of the day, what I would observe with the companies that we own and watch the performance, how they execute, they're able to describe it. They keep it very simple. And that's probably the common theme of just focus on operational excellence and being great capital allocators.
And just looking back again on the past 17, 18 years, we've talked about the extraordinary success that you've had. Could you talk a little bit about some of the not the less glorious moments and what you've learned from them and how you've perhaps adjusted your model or your business to reflect that?
Sure. So there are different buckets. There's the error of picking the wrong company. That happens less and less. The last time it was really bad, where it was we never should have owned it in the first place. We're now coming. That was 13 years ago. So we're doing a much better job of not owning the wrong type of companies, but our errors essentially are of two types. One is of omission. There are lots of examples I can think of. Refusing to look at Dollarama when it was going public because I didn't understand why the family had sold 80% of the business to Bain Capital, and the concern of when there's a private equity sponsor taking something public, and I regret that. 10 years ago, deciding not to dig in on Gildan, which is a great company. Those are errors of omission. I often will describe the most critical thing that we do, because we have limited time and resources, is which companies do we dig in on, because it's going to take us a very long time to get to know whether it's cheap or not. And so there are those errors. And as I said, fewer and fewer errors well, for a long time, we're just making a bad choice. And then the other error that we make is a constant error, which is, do we get the weightings right? So assume for a second, and I believe it's the case, all of our 25 companies are great companies, but having 0.2% of the fund in one and 12% of the fund in another, is that right? And it's a critical component of our long-term outperformance. And there are lots of examples that I have where I look back and say, well, that was 8% of the fund 5 years ago, and I wish it had only been 3. But I'm not looking at the portfolio, looking back and wishing we didn't own it. It's just, do we get the forecast right? Do we get our cash flow forecast right? And it's a constant battle. When we would describe it, we know that every single one of our forecasts are going to be wrong. I'd like them to be on a symmetrical basis. I'd like them to be a little too high half the time and a little too low half the time. We're not trying to be conservative in our forecasts. We're trying to be ultra conservative in our portfolio construction after we've developed a quality long-term view.
And let me shift gears a little bit to investors. So, you certainly haven't kicked us out yet, which we appreciate. But is there anything to be said, or do you have a perspective on the optimal investors that you attract and the investors that you would rather not attract?
Sure. I mean, I think like any fund manager, you'd like fantastic, long-term, patient, permanent, and frankly, in a sense, passive. In other words, not complaining or not asking for explanations all of the time. And so that's what we would like. The problem is you never know who's who. And so we've given up on trying to assess people at the outset. The number of times that I've described what we do to people and they nod their head and then they invest, and then they get their first statement in the first year and they're down. And this happened recently because with the markets falling in August, we were down. And one of our newer investors reached out and said, I thought you protected the downside. And I said, well, we never said that. We're not trying to mitigate volatility. We are embracing volatility. We've simply said we're trying to build our lowest risk portfolio. So there's no way to know ahead of time the quality in the investors and in our experience. So we're quite happy to take money from anyone.
And as you've grown, but you have grown considerably, certainly since we've met. Gone from a few $100 million to, which is now approaching $1 billion. And I know at the last annual meeting you talked about challenges of size. Some of the research out there has definitely shown that size has been a huge impediment to continuing to achieve the same level of outsized returns. How do you view that? What do you think is your capacity? And to what extent does size play a role in your decision making?
So I think I described it at our annual meeting that right now we're in a virtuous circle or cycle of having more assets under management. And at some point, if we're not careful, it can become a vicious cycle. We're not there yet. And the reason I describe it as virtuous today, it's really a couple of things. One is attracting talent. So if you have a couple $100 million under management, and a lot of it is your own internal money, and it's some other people you know, to convince the brightest young people to join you is not so easy. Now that we're at $1 billion of AUM, we just had someone join our investment team a few weeks ago from another investment firm, which is the first time that's happened. He's quite young, a year or two out of school. And that wouldn't have happened when we were at a couple $100 million of assets under management. So that's one benefit. The other benefit is dealing with our companies. So I think our companies like to meet with us. I think because we ask decent questions. However, it's a lot easier to have that meeting or have that follow-up phone call when you own 3 or 4% of the company as opposed to 0.5% of the company. So I think in both of those cases, the being at $1 billion versus a few $100 million is a benefit. It becomes a constraint or a problem if we can't rebalance our fund because we're quite active in rebalancing, as I've described. I don't think that'll ever be a constraint because we're the people who are on the bid side all the way down. In a sense, we're a source of liquidity for the market. And in this year so far, we were simply, I think, about 1.5% of the total trade across our portfolio. So we're actually quite small. We're not that active. We're just simply bidding and offering stock up and down the line. Where it becomes a constraint is when we want to own more of a company and we can't. So today we own more than 10% of 2 companies in our portfolio. And so if we had twice as much money, that's a constraint because those of you who understand the public markets, and it's quite difficult to own more than 20% of a public company, or at least then to be active the way we like to be active. So if that started to become 3 or 4 or 5 companies where we said we'd like to own more but we can't because we're approaching 20%, that's our constraint. Right. Is that $2 billion? Is that $2.5 billion? It's really a function of the market caps of the companies and where we find the most value. If our investing strategy was with small cap companies, think of it as 300 to 500 million market cap, we would be done now. We wouldn't be able to manage more money. It's simply a function of the size of the companies that we own.
Thank you. What keeps you up at night?
I don't worry, I guess. And so when I come to conferences and I listen to people who are worried, I do a bit of a sanity check in the fact that we're not worried. And I think what I realized in the fall of '08 and the credit crisis, when I would read about other managers, about how they were going to cash, and I thought, if half of your headspace when you're as an investor is to think, should I be in the market or should I not be in the market, we don't spend any time thinking about that. Again, coming from private equity, the way we think about it, we simply own 25 companies. So it doesn't bother me that, and it is the case, the share prices of some of our companies are lower today, a couple of cases quite a bit lower than they were at the first of the year, just because they are in the oil and gas service sectors, and that doesn't bother me. We're taking a long-term view. None of our companies have too much debt. I don't know how I would have felt in the fall of '08 if we owned banks, but we didn't own any banks. So we own companies with strong balance sheets. So I sometimes worry that I should be more worried, if that makes any sense. I will say that when I go to Fairfax Financial's annual meeting and listen to Prem Watsa, you can come out of that session and think maybe I should be in cash. But other than that, no, we're just owners of companies.
Well, you got to bottle and sell that because
Right.
It's a great strategy. Andrew, thank you so very much for joining us. Really appreciate you sharing your insights. Thank you.